Meanwhile, members of the organized private sector and economists have backed the Monetary Policy Committee of the Central Bank of Nigeria's decision to retain the benchmark interest rate, describing it as the most sensible option amid global uncertainty. The MPC had yesterday, Tuesday, retained the monetary policy rate, the benchmark interest rate at 26.5% for the second consecutive meeting, citing renewed geopolitical tensions in the Middle East and persistent inflationary risks, despite a slight moderation in domestic inflation. The governor of the Central Bank of Nigeria, Olayemi Cardoso, who announced this at the end of the MPC's 306th meeting in Abuja, which was attended by all 11 members, said the MPC also retained the standing facilities corridor around the MPR, that is the monetary policy rate, the cash reserve ratio at 45% for deposit money banks, 16% for merchant banks, and 75% for non-treasury single account public sector deposits. The decision follows the committee's previous decision to hold the rates after implementing a 50 basis point cut in February 2026, and that also comes despite a marginal decline in Nigeria's headline inflation rate. Now, while the economists, the members of the organized private sector and economics backed the policy and the decision, they urged the federal government to begin easing the rates when inflation and external rates moderate to support manufacturers and other productive sectors.
The governor of the Central Bank of Nigeria, Olayemi Cardoso, said the committee retained the standing facilities, corridor and cash reserve requirement to allow closer monitoring of economic data and inflation. He identified the renewed Middle East conflict as a major risk to global and domestic economic stability, warning that rising crude oil prices, supply chain disruptions, and exchange rates volatility could worsen inflation.
The MPC welcomed the positive outcome of the banking sector recapitalization exercise, noting the improvement in the resilience of the banking system as reflected in key prudential and financial soundness indicators. It nevertheless urged the bank to sustain effective surveillance to preserve financial sector soundness and mitigate potential risks to financial stability.
Cardoso said Nigeria's economy remained resilient, with real GDP growing by 3.89% in the first quarter of 2026, driven mainly by the non-oil sector. He added that the country's external reserve rose to $52.52 billion as of July 17, enough to finance about 11 months of imports. He commended the banking sector recapitalization exercise but called for continued surveillance to safeguard financial stability.
Gross external reserves rose to $52.52 billion as of July 17, 2026, from $50.47 billion as of end of May 2026, mainly as a result of receipts from crude oil-related taxes and third-party inflows. This is sufficient to finance approximately 11 months of import of goods and services, surpassing the international benchmark of 3 months cover.
As the Central Bank of Nigeria maintains its tightening stance, businesses and consumers alike continue to watch closely to see when the impact of easing inflation will finally reflect in the markets. From Abuja, Marian Inahimion, MITV Plus News.